Hello class, welcome to another episode of B Grade Economics. This is Nate, your class leader. Let's get started. So today we're going to be going over valuing a company. This will be a long series to get through and understand, and even then, even once you develop your ability to value a company, you'll find the value is subjective to your needs and uses. So it matters to you what the value is to you as an individual for your portfolio. So we'll be going over the basics of value, and then we'll start with some company metrics just to get us onto the subject path. So Warren Buffett has been quoted as saying many things, but one of them that's used often to describe value is price is what you pay, value is what you get. And value is the importance, worth, or usefulness of something. So the price of something is irrelevant, as in the dollar amount or currency units, the unit of measure, compared to what the thing offers you. The currency units only matter in terms of the opportunity cost of the value they can purchase elsewhere. If the thing that you need is absolutely the most crucial piece to your portfolio, life, or existence, you will pay whatever it costs. Examples of value that, regardless of price, we will take a hold of are oil. So buying gas for your vehicle to get to and from work. The only price that it'll stop us from using it is when it now costs us more to get to work than actually going to work. So that's an example of something that we will pay that price until it's no longer beneficial or valuable to us for that comparison. So when we talk about intrinsic value, this word's used a lot, and I want to come out and dash this one as quickly as possible. We'll bring this one up again and again, but it is a cultural problem from Marx's value theory. So Karl Marx, at one point in time, had suggested that value was intrinsic to the things based off of just how they are and exist on this planet. So it involved a concept of supply and demand, but the supply was limited by the entire planet, and all values of each thing were equal in that matter. So any unit of gold, no matter where it is on the planet, has the same value for both the labor imbued to pull it out of the ground, as well as the value that it is the thing that people utilize. But even he started to shake on this, and he didn't stick to his ideas very long, but it took hold very much in the growth of Soviet and the growth of communism and socialism throughout Eastern Europe. And that mindset started to trickle into the language of calling things as intrinsic value, something that holds value no matter what. But we'll find that that's not really true, and that value can change drastically. Anybody who's ever seen or heard of a mining company fail would find that it didn't matter what the intrinsic value was, it mattered what the price that people were willing to pay for the value they had for it at the time. Now, when we talk about comparative value, this starts to make a little more sense on that supply and demand curve. When you do comparative value, you're just comparing the value of one good to another based off of them in a nascent space. So if you were to do Tesla, Ford, and GM and say these are all car companies, then obviously Tesla would be immensely overvalued. The example here has Tesla being at 103 billion. Well, now it's a trillion. So take from it what you will, but comparative value does not always make complete sense in just looking at single pieces of information or looking at something through a single lens. Subjective value is a much more adept way of talking about value when you're talking about what the value is to you. And as I said in the beginning, the value of something to you, the opportunity it provides you, is much more important than anything else. And so when we talk about subjective value, this has to do with what you need at the time that you need it. When human beings exchange something, they never once think that at the time of the exchange that it is not the good exchange that they need. At the time, the compromises that they're making to make the exchange, they believe they are in profit. In other words, they prefer this asset over another. Now, buyer's remorse can set in very quickly. You can make a decision and then in the middle of the trade, continue the transaction while you already have the buyer's remorse, but that doesn't change the fact that at one point in time when you agreed to it, there was a cost-benefit analysis executed in your brain that told you that it was a better choice to go this way or that way. Now, it could be that you don't value the object, but the other things that came with it, such as a political opportunity with social networking or whatever, it doesn't matter. At one point in time, you valued that transaction in your favor. Now, let's dumb it down to a deserted island. Let's pretend you're this T-Rex on a deserted island. You value fresh water on that deserted island much more than the T-Rex that is in a warehouse full of water. Now, this T-Rex doesn't understand values. He just knows what he wants. He just has base impulses to eat and to breed. Speaking of, has anyone ever thought about how T-Rexes breed? Weird side note, but I have no idea. I don't think scientists completely know. They've kind of done like drawings and examples, and it's a very weird concept. They have tiny little arms. It's like a chicken, but like, do you understand how birds mate? I mean, that's a weird function altogether. Are these reptiles? How does it work? Either way, I imagine it's not such a great sight to look at, but we'll move on from here. So when we start talking about companies and their financials and valuation, we kind of have to get an understanding of what we're looking for in our portfolio and then use that to help us value the company as we see fit. One method is called a revenue multiple. This works on companies that are operating at smaller expenses than someone like Apple. And so we can use Apple as the example. We can take the total revenue, as in the money that they exchanged throughout the year, that they brought in throughout the year, their total revenue, and use it to divide the market cap, and that would give us our current multiple. So you take $2.48 trillion as the market cap of Apple, you divide it by 365,817,000, and you get 6,799.34. That is a very large multiple. And I say that because in 2020, the average for tech companies was approximately 16.1. So even a higher grossing company like Apple shouldn't have one so high. So we can also check how overvalued or how high that multiple is by taking the total revenue, multiply it by the multiple, and you should get the ceiling for what the valuation of the company should be. So according to this method, Apple should be trading for $5.89 billion. I don't think anyone thinks that's a reasonable statement if they understand Apple. Value investors using this method might find that it doesn't work too great. Now, I did choose an example that shows a very big bubble in Apple by using this method, but it's just to show the concept of how it functions. You'll find that in smaller companies, using the revenue method, the revenue multiple method, can work out in your favor in terms of finding how well that revenue feeds into value. And mainly, if you're a value investor, you're looking for smaller cap companies and they don't have a lot of other historic info to go off of, or good comparisons, especially if they're technology and they really are a niche that is unique and they don't have a lot of competitors. That is a great way to start identifying, is this company already, grossing any revenue? How much debt do they have? But we will find that they trade high on their revenue multiple no matter what in tech, because these companies have a lot of debt and do not have a lot of revenue at the beginning. PE ratios. This one I prefer because it's very simple. If you're a value investor, typically a fair value is 20 PE. That's a pretty fair value range. So if it's under 20 PE, congratulations, you found a relatively low price stock, a stock that is good value for the price, right? You're getting a lot more than what you're paying for. So when we talk about the price earnings ratio, it's simply dividing the earnings per share, or the market value per share, by the earnings per share. And so we can find these really easily on any stock sheet. This is on Yahoo. You can just look and find the PE ratio highlighted in green here, and boom, there you go. It's trading at 26.97, and now Apple suddenly doesn't seem like the world's biggest bubble, but it is high. At least it's got a good earnings per share, and so it isn't as atrocious as it appears in the multiples format. Now, if we want to consider debt, and you want to get familiar with the company, you can find obviously on this balance sheet, you can find its revenue, its cost of revenue, and gross profit. Part of cost of revenue is debt, and so you want to know that the company has debt that it can service. So if you're trying to find value, this doesn't always apply, because sometimes the debt is high at the beginning because the company has to issue debt in order to be able to produce things, and so the revenue doesn't kick in till later. So the first few years of a company may not be very profitable, but that's where the speculative opportunity for growth comes in. If the company's already having revenue and you're looking for a dividend stock or a value growth stock, then you would use this to assist your information. Is the company drowning in debt? We know that by the revenue alone, and you can find by the profit alone, that Apple could very much pay off its debt immediately. It's not a concern for Apple, which also has a very large treasury, how much debt it's currently using, because it is not swimming in its debt and it can manage it. It can also do that through share selling and things like that. So if Apple wanted to, Apple does not have a problem running its debt. Much like if your household had debt and you also have a paycheck and your paycheck covers more than your debt, you're already good to go. If your debt is less than a third of your income, then your revenue is high and your debt is relatively low. So these are things to just consider when you're looking at these companies. Is always take a look at the debt just to make sure whether or not the company's high in debt, and then you need to know why they're in debt and what they're doing with that debt. Finally, another way is historic. Typically, this is done in the form of charts, but you can also just do how has the company performed. Price-earnings ratio is an example of a historic comparison. But the past performance does not guarantee future results, is the common disclaimer you hear everywhere. That is because just because something happened in the past does not mean it's going to continue forward. The company could underperform later. And what goes up must come down is another great mantra to use, as well as gravity works in a downward fashion. So the company Apple has, unless you've been living under a rock, Apple has been growing drastically. Everybody knows someone who owns an iPhone, unless you're a very weird person who excludes friendship from people based off of the asset that they use to communicate digitally. But Apple has been very successful for the past 20 years, and so we can assume from this trend that it will probably continue another 20 years of generally good growth performance. That is not guaranteed because, as we talked about bubbles, it could also take a very long time for it to come back to the prices that it's at. Another thing you can do is compare it to other assets. You can compare Apple to the Nasdaq. In these examples, I have Apple to Microsoft. And so Apple and Microsoft is a great comparison because for the past around 10 years since the advent of the iPhone, and they had all this growth in their iProducts, because does anybody remember an iPod? Not very many of us. I never owned one. But the performance of Apple over Microsoft has had some swings. And so at this point in time, in the past 10 years, we would say you should be loading up on Apple because Microsoft has traditionally gone back down in value compared to Apple. But at the same time, is Apple going to outperform Microsoft over the next 10 years, or has Apple run its course? These are where, again, historic performance is not exactly a guarantee of the future. It just gives us a trend of what has generally occurred and how has it been performing. We also find that Apple is in a general downtrend against Microsoft. So we can assume from this that there may be a possibility of it going either way in terms of which one would you rather hold. We can also compare Apple to Samsung, and you can say, oh, well, Samsung is a great phone company, a great computer company. They've really been building up a great basis in value. Sure, but the company versus the product are two separate things. And that's something to remember because this is being made on a Samsung computer, which I very much like, and I find is a better value than the iPad, than the iMac that I would have gotten. But the company, I think, is probably going to continue to outperform. If there is a downtrend in Apple, there's probably going to be a downtrend in Samsung because in general, the stock market would probably be having a hard time. I think that Apple's going to continue to outperform Samsung in the long run. So just as an example of how you could use a basic comparison of how does this company perform against another. Historically, it seems that the chart trend in growth has done this. You could also do the same thing for PEs and compare their PEs and find that as which is better, this or that, and then see how they've done previously and see if the companies are looking to increase their earnings per share for the customer and become a better dividend stock. And so that'll conclude this section of the class. We'll come back to valuing a company later. In the meantime, we'll go over simple options because I know that I introduced that early on, but then didn't give a very deep explanation. So I'm hoping to get people on board with understanding how options work and getting into that leveraged risk. I will be very cautionary in that instruction. When it comes to our trade, we executed our first trade very well. Sadly, we didn't get to take advantage of the next leg in the move as I was being overly cautious, which, everything's a learning opportunity. And I know normally I would follow the trend up until it breaks, but in this case, the goal was to double, and most of the risk indicators were saying that we shouldn't try to push our luck. So we'll see how this goes. We'll continue to find the next opportunity. Don't know if it'll be in the Nasdaq, it'll be in some type of commodity or some other individual stock, but we'll find out. Again, you can follow me on Covey.io or start your own portfolio on Covey.io just to learn how to track and manage an active portfolio and find what works best for you there. So far, so good on mine, and I hope to see you next time.